Hello and welcome to the Q2 2025 strategy update call for TICE and TICE Alpha Opportunities. My name is Brian Tujan, a member of the business development team here at iCM, and I'm joined by our Director of Investments, Ryan Lehman, who'll be taking you through today's presentation. Presentation should take about 20 minutes, and at the end of that, we will have a short Q&A session. If you have any questions throughout the presentation, please don't hesitate to submit them through the Q&A feature in Teams webinar. We'll address those questions at the end. Again, thank you everyone for joining us. I'm going to hand it over to Ryan.
Great. Thanks, Brian. Good afternoon or good morning to everyone. I just want to thank everybody first off for taking time out of your busy schedules to join us for the call today. Like Brian said, my name's Ryan Lehman. I'm the Director of Investments here at iCM. And as usual, very pleased to be your host for our quarterly update on our TICE and TAO strategies. So just a quick look back at Q1. It was really a reversal on just about all fronts from what we saw in 2024. U.S. stocks underperformed, ending the quarter in negative territory, while non-U.S. stocks led markets higher. And then we saw bonds get off to a pretty good start as well, with rates falling pretty much across the yield curve. Now, closed-end funds as a whole had a pretty strong start to the year. However, across asset classes, performance was a bit mixed. So discounts were really led lower by international muni funds, which had been laggards for much of the last year or so. And then we saw just a little bit of movement on the taxable fixed income front. Now, like Brian said, throughout the next 20 minutes or so, we'll talk about the implications this had for our tactical income strategies, TICE and TAO, how we manage these portfolios through the first quarter of the year. And then in addition to just talking about closed-end funds, we'll take a look at our return expectations for really a broad spectrum of asset classes and how that's impacting the composition of TAO's high conviction asset sleeve. So with that said, let's go ahead and start our discussion of closed-end funds and talk about our flagship TICE strategy. So just to start off with universe-wide discounts. So during the quarter, discounts narrowed a bit despite U.S. equity markets selling off and volatility increasing. At the end of the quarter, we saw discounts narrow by just about 150 basis points. So we're currently sitting at just over 4% below NAV at a universe level, which is basically in line with the long-term average. That's right around 4.5%. However, if we dive a little bit deeper into performance, it was relatively skewed by some pretty meaningful differences across asset classes. So munis, here they had a strong quarter with discounts narrowing by more than 2% on average. This was largely driven by the interest rate environment, which we're going to touch on shortly. While taxable fixed income funds, they saw discounts narrow by less than 100 basis points as that heightened equity market volatility that we experienced in March put a bit of upward pressure on credit spreads. And then the final asset class that I wanted to touch on was international equities, which we usually gloss over because they've been pretty stable for much of the last couple of years. Here we saw discounts narrow meaningfully, more than 3%, as investors began to kind of start shifting away from expensive U.S. assets into markets overseas. And now on this slide, we're going to see how the discount environment changed on a quarter-over-quarter basis, which honestly was pretty benign. So starting with the chart on the right, you're going to see that about 79% of the universe is trading at a discount to NAV. This has come in just a little bit since the end of 2024, but we're still tracking above that long-term average of 76%. So still definitely some opportunities to be had out there. And then when we look at the distribution on the left, you're going to get a bit of a better picture of how universe dynamics actually changed. And more specifically, what you're going to notice is that you're going to see the distribution shift just a little bit to the right. And this is going to largely be attributable to those international funds, which entered the year at an average discount of more than 11% and then ended the quarter at just about 8%. So now to switch gears a little bit and take a look at some of the key drivers of closed-end funds. So here we're going to start with interest rates. So interest rates in closed-end funds tend to exhibit a negative correlation, meaning that when rates decline, closed-end fund discounts tend to narrow, and when they rise, discounts tend to widen. This typically is going to occur with one caveat: when we have rates decline due to an event of extreme market stress. So if you think like the COVID pandemic or financial crisis, you're going to tend to see this relationship actually turn positive. And I've got those periods kind of notated on the slide here. So just to expand a bit on what we're looking at on this slide, so we've got the 10-year U.S. Treasury yield in blue, and then the average muni bond fund discount in orange. Here, we're comparing it to munis because they tend to carry a little bit more duration, tend to be a little bit more interest rate sensitive than the taxable side of the closed-end fund market. That's going to be more credit oriented. We're going to look at that next. But what happened in Q1? So in Q1, we saw rates decline meaningfully. So we saw the 10-year yield fall from around 4.56% at year end, actually spiked as high as around 4.8 in January, and then ended on March 31st at 4.2%. And then as expected, muni bond discounts narrowed pretty meaningfully, with the average discount declining from about 8.5% at the end of the year to just over 6% at quarter end. And then next, if we take a look at the relationship between discounts on taxable bond, closed-end funds, and credit spreads, spreads on the quarter gapped out a bit, primarily in March. So they moved from less than 300 basis points at year end to just shy of 350 basis points on March 31st. And while this is a move off those historically tight levels, they still ended the quarter well below the long-term average of about 500 basis points over treasuries. And I really think this is the likely reason that we didn't see a meaningfully negative impact on taxable bond discounts during the quarter. Now, that said, though, amidst the volatility we have seen over the last couple weeks, we have seen spreads move out by as much as an additional 100 basis points, which has weighed on taxable closed-end fund discounts. And that's not shown on this slide, but amidst the volatility, discounts moved out to as much as 5.5% below NAV, settling back down to about 4.5% earlier this week. And then lastly, here we see the relationship between equity market returns and broad closed-end fund discounts. Now, in terms of this relationship, behavioral finance, or the tendency for investors to over and underreact, is going to play really a primary role in driving closed-end fund discounts, because as many of us know, the closed-end fund market does tend to be very retail driven, so very reactionary. And that's exactly what you're going to see on this chart. Declines in equity markets and high volatility environments do tend to cause closed-end fund discounts to widen, while periods of strong returns and or low volatility tend to cause discounts to narrow. Now, the recent activity that we've seen is kind of missed in this chart because volatility didn't really spike until after the end of the quarter. But similar to what I talked about on that prior chart, at peak volatility prior to that tariff delay that we got on April 9th, universe discounts did move out to more than 6.5% below NAV. This is the widest that we've seen them since the middle of last year. And today we're sitting close to around 6% below NAV. So more attractive than they were at quarter end, but only about 1.5% wide versus the long-term average. So taking all this into account, let's take a look at how these market dynamics has impacted the performance and positioning of our flagship closed-end fund strategy. So if we start by looking at portfolio attributes, our closed-end fund exposure was pretty stable on a quarter-over-quarter basis. It actually declined by just a tick, which brings our overall allocation to pretty evenly split between closed-end funds and ETFs. This was largely the result of that continued discount narrowing that we saw within the taxable fixed income segment of the market. And now that's not to say that we weren't trading throughout the quarter, because although we are net 1% lower in our closed-end fund allocation, we did make a handful of swaps from expensive funds to those that were trading at much more attractive valuations. And also, that said, I could definitely see this moving in the other direction if volatility does continue and discounts continue to widen out a bit. Now, from a discount standpoint, at quarter end, we saw our average closed-end fund holding trading at a discount of over 8%, which is about 200 basis points more narrow than where we ended the year. This was clearly additive to performance for the quarter, something we're going to see in a couple of slides. And then as of quarter end, TICE was offering investors a distribution yield of 4.9%. So this is actually down a whole percentage point from the end of the year. And all this is largely due to the fact that discounts narrowed throughout the quarter and rates declined as well. However, with the recent movement in rates ticking up, credit spreads coming out, that yield is going to be higher today to the tune of about 5.3% as of earlier this week. So now to speak to where we're finding the greatest opportunities, here we're looking at the closed-end fund versus ETF breakdown for each sleeve of the portfolio, along with the average discount within that sleeve. And what you're going to notice is we're clearly finding the least opportunity in U.S. equities and taxable fixed income. So we've got 69% and 68% allocated to ETFs respectively in those sleeves. So for U.S. equities, this has been relatively high for much of the last year plus, as discounts never really gapped out for equity funds on a relative basis at least. However, I think an important observation to make here in regard to our U.S. equity allocation is that despite the universe not looking great as a whole, the funds that we are invested in are trading at pretty attractive discounts. They've got an average of more than 12% below NAV at quarter end, or 88 cents on the dollar. Taxable fixed income also saw little change throughout the quarter, with discounts trading really narrow in that space. However, similar to U.S. equities, the funds that we do own are still trading at attractive valuations. The average discount there is more than 9%. And like I mentioned a little bit earlier, again, these two areas, they may start to look more attractive if discounts do continue to widen and volatility persists like it has over the last few weeks. Now, on the flip side of this, we're still finding a really good deal of opportunity in our muni bond sleeve. So here we are 100% allocated to closed-end funds, with the average fund there trading at more than 7% below NAV. Now, being 100% allocated, we don't have room to add if discounts do continue to widen from here. However, what I could envision is us swapping out some of those slightly expensive funds or less attractively valued funds for more attractively valued funds as we look ahead. In particular, some areas that might become attractive if credit spreads continue to widen is going to be within the high yield space. And then the shift over to performance to take a deeper dive into the actual performance for our TICE strategy. What I'm doing on this slide is basically decomposing the strategy's returns into the three core building blocks. So we have capital appreciation, your dividend income or your yield, and then closed-end fund alpha. Now in Q1, we saw positive returns from the strategy, gained 53 basis points on a net composite basis, with returns largely being driven here by the income and closed-end fund alpha components. So you're going to see 116 basis points of positive contribution coming from your yield. Closed-end fund discounts narrowing contributed 76 basis points, and then asset class performance was actually negative, detracting 150 basis points. And I think this slide just gives some really good insight into using a strategy like TICE, where you've got the potential to benefit from multiple sources of return, and in particular, that unique closed-end fund alpha component, which isn't going to be accessible to traditional mutual fund and ETF investors. And then just to translate all of this into longer term performance. So results have been relatively strong over just about all periods. So near term, the gross composite led its benchmark by about 30 basis points on the quarter, and it's ahead by 125 basis points over the 1 year period, which I view as pretty impressive given the strategy's allocated just 40% to equities. And then over the long term, you're going to see outperformance of 286 basis points annually over the last 5 years, and then 71 basis points annually since its inception back in October of 2016. And then from a risk standpoint, since inception, we've got a beta to the S&P 500 of 0.66, about 3/4 of the volatility to the all equity index. And all this is generally in line with our expectations for the strategy, given that closed-end funds they're going to have a little bit of higher beta to them. So just to sum up, I'd say that recent results are pretty in line with what we'd expect given the current state of the closed-end fund market. And given that discounts have widened a bit over the last couple months, it could be setting the strategy up for some pretty strong returns as we look ahead. Now, for the remainder of the presentation, we're going to switch gears and talk about our TICE Alpha Opportunity Strategy, or TAO. And just to kind of level set for those who aren't familiar, TAO is a unique set of strategies that's going to combine our TICE closed-end fund alpha strategy with a portfolio of undervalued assets that we call our high conviction tactical assets. So everything we've talked about thus far in the first half of the presentation is going to apply directly to that tactical closed-end fund piece of the portfolio, which is just an asset-weighted version of TICE. And then in the next few slides, what I want to do, though, is touch on where we're finding value from an asset class standpoint, and then how all of that has translated into performance for TAO. So if we start out with our long-term return expectations, which is really going to drive that allocation, the order here has not changed very much, but we have seen some marginal improvements in our U.S. equity market expectations. The reason being, you got a near 10% sell-off in growth stocks in Q1, and this has really helped to improve that overvaluation story. Now, one caveat though, even though U.S. equities, U.S. large cap growth stocks have sold off, both of them are still around the 90th percentile in terms of historical valuation levels, so still pretty pricey. And as a result, our expectation for growth, that's moved up to 2.1% annually over the next decade, while U.S. large caps have moved up to 3.6%. So again, an improvement, but still well below what investors have experienced historically. Now, if we dig a little bit deeper into the U.S., value stocks are expected to return around 5%, so a clear improvement over their growth peers. And then you've got small caps, slightly higher than U.S. value stocks, but this does come with significantly more volatility. So just thinking ahead, there may be an opportunity here at some point, especially if they kind of continue on the current path. Volatility continues to be high and they continue to sell off, but I just don't think we're there yet in terms of getting the best risk-adjusted return. And then if we look over to the left-hand side of the or the right-hand side of the slide, you're going to see our standout non-U.S. Equities, all of which have double-digit returns. And this is going to come despite that strong performance that we saw in Q1. And the big driver of this differential is really going to be two things: valuations and currency, both of which favor non-U.S. stocks over the long term. Then on the fixed income side of the market on the bottom, you're going to see we still have EMD with outsized return expectations. This is really due to a combination of their attractive yield and then exposure to an undervalued currency basket. While most investment grade fixed income asset classes, they're expected to return in the mid to low single digit range. Short-term treasuries, they do remain attractive at the moment, given the current shape of the curve and the potential for capital appreciation as the curve does eventually get back to a more normal shape, which we have been starting to see over the last month or so. And then the way this is going to translate into the portfolio's actual asset allocation is shown on the two pie charts here. So on the equity side of the portfolio, you're going to find our highest allocations of 55% and 30% to emerging markets value and international value, respectively, while commodities are going to get away to 15%. No major changes here on a quarter-over-quarter basis. And then on the fixed income side of the portfolio, kind of a barbell position here. So you've got EM local bonds. That's going to be your risky asset on one side of the portfolio, and we're going to balance that out with an allocation to short-term treasuries. No change here either from last quarter. Now, getting into our rationale for our high conviction assets. So if we start with non-U.S. value stocks, major story here is valuations and currency. So on this slide, we're looking at valuations through the lens of price to trend line earnings ratio. And what's compelling is what we see from both emerging and non-U.S. value stocks. Now on the developed side, and when we say developed, think Europe and Japan primarily, valuations are pretty close to near historic levels, meaning that we are likely to see a positive contribution to future returns from PE multiples expanding, which is going to run counter to the US, where valuations are likely going to cause a meaningful headwind as we look ahead. And then if you look at EM value, you're going to see similar results. We've got price to trend earnings in the mid single digit range versus a long-term average that's about 15. And then there's the dollar. This has been a massive headwind for non-U.S. assets over not just the near term, but over much of the last decade. So in fact, as we are entering 2025, dollar strength actually detracted about 200 basis points per year from U.S. investor returns in developed markets over the last 10 years, and then nearly 250 basis points per year from EM equity returns. That said, though, we've seen a pretty meaningful reversal so far in 2025, with the Bloomberg Dollar Index actually declining by more than 3%. And this all comes despite concerns over Trump's tariff announcement and the potential for a global trade war. Some potential explanations for this. There's a number out there. I'll just mention a couple. So they're going to include an increased lack of faith in the U.S. amidst all this trade uncertainty, potential deterioration a bit of the U.S. exceptionalism story, as well as foreign investors moving assets out of U.S. markets and into their own. All of this is going to directly speak to those sharp moves that we've seen over the last couple months. Now, that being said, though, this is all a short-term reversal, but regardless of what metric you look at, the dollar still appears significantly overvalued compared to both developed and emerging markets currencies, adding potentially that second tailwind to non-US asset returns as we look out over the next market cycle. And then if we move on to commodities, like 2022, they've produced a good deal of diversification versus U.S. stocks thus far this year. We all know U.S. stocks have struggled. Most notably, if we look at what's driving commodity performance, gold has soared to a new all-time high. That's really driven by strong demand out of global central banks, as well as its status as a safe haven asset. That said, what we're seeing on this slide is our historical return expectations for U.S. stocks versus commodities. And we currently have a gap between the two of just about 8% in favor of commodities. So this is pretty close to its highest level on record since early 2022. And then one thing that I want everyone to keep in mind in terms of commodities, not only do they currently offer an attractive return potential, but they do also add diversification to just a simple balanced portfolio. And like I mentioned a couple seconds ago, investors have definitely experienced that benefit thus far in 2025. And then moving on to fixed income, you're going to see EMD, which continues to be one of our favorite segments within the fixed income markets. So EMD was a top performing fixed income asset in Q1, continues to be more recently year to date. And this is largely driven by two things: the attractive level of income that these bonds are currently kicking off, as well as weakness in the dollar, which I touched on a couple minutes ago. And here what you see is our expected returns over the next 6 years. They're about 9%, and we can attribute this to yields that are currently over 6%, plus exceptionally attractive currencies that are still well below their long-term fair value relationship to the dollar, despite that rally we've seen over the last few months. And then lastly, just to talk about short-term treasuries, they still offer an attractive risk-adjusted return opportunity compared to many other fixed income assets. The reason being is that you're currently receiving a yield of just over 4%, depending on the maturity, and you have very limited duration risk. So thinking more short to intermediate term, when we do see rates start to come down and the curve does begin to normalize, investors have the potential to earn some pretty attractive returns with a very limited downside risk. Now, just thinking about how we value that opportunity versus longer bonds, what you see on this chart is a comparison of what we call the risk-adjusted spread, which just compares the yield difference on the 10 and the 2-year versus the duration difference, so basically a relative Sharpe ratio. And what we find is that we're currently still about half a standard deviation cheap, despite that move up in rates that we've experienced over the last couple of weeks. That said, though, we could see this position start to change here a bit as the curve reverts to a more normal shape and rates start to look more attractive at the intermediate and long end of the curve. And then just to finish up with some attribution and performance, here we see recent performance of our high conviction asset classes compared to their policy benchmarks. On the equity side of the portfolio, the Tau strategies did exceptionally well versus their policy benchmarks in the first quarter of the year. This was largely driven by the divergence that we saw in global equity performance, which was fueled by this waning optimism around that American exceptionalism story, and then a pretty significant pullback in the dollar. Commodities also did well as gold rose by about 19% on the quarter. And then our fixed income assets performed generally in line with their benchmark. So EMD outperformed due to what we talked about earlier. It's elevated income and exposure to the dollar, while short treasuries trailed a bit as rates fell across the yield curve. And then just to tie all this together, on the quarter, this resulted in strong results really across the board for our gross composites. Closed-end fund performance, a little bit mixed. So it was really our high conviction equity assets that propelled the strategies past their benchmarks. So this is going to explain that difference in relative performance across the various risk profiles. So we have the more conservative models slightly outperforming their benchmarks, while the more aggressive models are going to be well ahead of their benchmarks, actually posting positive returns versus modest declines for their respective indexes. Now, if we look over the last 5 years, income ops has gained 5.4% annually compared to 1.35% for its blended benchmark. Performance here has been supported by our closed-end fund alpha sleeve, so that added meaningfully to returns for really every year except 2022. We've also seen some value added from our short treasury and EMD positions. And then for Tau 80/20, you're going to see excess returns of just about 200 basis points annually over that same period. And unlike income ops, this was largely driven by our positions in commodities and non-US value assets. They provided a significant level of downside protection in 2022 sell-off, as well as that strong start for international assets and commodities that we've seen in 2025. And I think all of this, just one last note, I think all this just really highlights an important component of TAO, and that's its ability to benefit from these different sources of return. You have the two closed-end fund alpha and then those undervalued assets. And what they tend to do is they actually run in very varying market cycles. And this really helps to provide competitive results across a variety of market environments, which is precisely what we've seen in practice since the inception of the strategies 5 years ago. And that concludes all my prepared remarks for today. So, Brian, why don't we go ahead and check the Q&A box to see if any questions have come in?
All right, thank you, Ryan. So if you joined us late, if you have any questions on today's presentation, please submit them through the Q&A feature in Teams webinar. We have two questions, and Ryan, the first one is, what impact will the tariffs have on closed-end funds?
Yeah, really good question with all the uncertainty out there right now. And I guess the way I would answer that is I don't think it's a direct impact, but it's more of tariffs' impact on market uncertainty and then how that uncertainty plays into closed-end fund discounts. So if we think about the key drivers that we talked about that are really going to drive the levels of discounts in closed-end funds, there's three things. There's rates, credit spreads, and equity market volatility. And while the rate impact could be a positive, depending on how all of this plays out, the credit spread and volatility factor are likely to cause discounts to widen like we've seen over the last couple weeks. But I'd actually view this as an opportunity more so than a risk, because the way that we're currently positioned is pretty conservative in our taxable bond and equity closed-end fund sleeves or portfolios. So discounts have been pretty narrow in these two areas, given how well high yield bonds and stocks have really done over the last 2 years or so. And we currently have a higher than average allocation to ETFs in those sleeves. So if we do see spreads move out and equity market volatility continues to be high, this is likely going to provide some really nice opportunities to pick up additional funds at attractive discounts. And historically, these types of periods where discounts have widened and we come in kind of conservatively allocated have been followed by pretty strong relative returns for the strategy. So I think it's definitely has the potential to cause some uncertainty, a little bit of volatility in discounts, but we view that volatility as a potential opportunity more than a risk.
All right, thank you, Ryan. And we have one more question. It is, have the number of discount opportunities in closed-end funds increased with the recent market volatility?
Yeah, so short answer is yes, but I think there's a really big caveat here. So discounts gapped out pretty meaningfully after the whole Liberation Day announcement, and they have come in a tad since then. So all in all, closed-end funds and discounts are more attractive than they were at the end of the quarter. So that's the yes. However, the caveat is you have to consider where we are coming from. And in the case of taxable bond funds, they were trading at pretty rich levels, almost as rich as they've ever traded. So this really just helped to reset a lot of those funds back closer to fair value. It hasn't necessarily made them cheap. And I think this is the same story more generally for credit spreads. So we aren't at historically tight levels anymore, but we're still below what would be considered the long-term average, so still not at fair value. I guess that said, though, I wouldn't be surprised to see us selectively adding some more exposure to closed-end funds across the portfolio. But we want to be patient and wait for those discounts to move out to levels that are much more attractive before we kind of back up that proverbial truck and shift our allocations meaningfully.
Great, thank you, Ryan. That appears to be all the questions that we have for today's call. I would like to thank everyone again for joining us for the strategy update for TICE and TICE Alpha Opportunities. Today's update is being recorded, and the video replay will be made available on the iCM YouTube channel. We'll also, if you have any questions, please don't hesitate to reach out to us. Our phone number is 888-426-4689, or by email at info@icm-invest.com. Again, thank you everyone for joining us, and that concludes today's strategy update.